Hi, this is Chiro. Today I'm going to talk about what it means to invest in a SPAC using Tortoise Acquisition Corporation 2, ticker SNPR, to illustrate. This is not to be confused with the first Tortoise Acquisition Corporation, which plans to merge with Hyliion by the end of September 2020. Getting right into it, when you invest in a SPAC, or Special Purpose Acquisition Company, you're buying shares that represent money that will go towards funding a typically privately held company. As opposed to exchanging currency or buying bonds, however, buying into a SPAC is like buying a management team's promise that they will find a company to fund using this money, and that the company they find is expected to one day turn a massive profit. Tortoise Acquisition is one such example of a management team that forms SPACs, and they've chosen to go all in on turtle puns. A SPAC is a kind of a shell company that doesn't do anything in and of itself, so the ticker for their first acquisition was SHLL, or Shell, and the ticker for their second acquisition is SNPR, as in a snapper turtle. Anyways, using SNPR, which I'm going to call Snapper, as an example of a SPAC, they've raised $300 million and are looking for a company in the energy transition and sustainability arena with innovative solutions to decarbonize. SPACs will typically offer common shares that start at a value of $10 and eventually turn into shares of the company being acquired, as well as warrants, which represent a right to purchase additional shares of the company being acquired at a future date and at a set price, that is $11.50 for Snapper. Snapper units, which trade under SNPR.U, represent one common share plus a quarter of a warrant. This is just how Snapper set up their units, and isn't really something we need to analyze as retail investors. At the time of recording, Snapper hasn't identified any targets to acquire yet. My goal with this video is to provide some context on what it means to invest in a SPAC at various stages using actual companies as examples, and to get you to smash that like and subscribe button while I run through a disclaimer and an incredibly long run-on sentence saying that this video is for informational purposes and that nothing I present should be taken as investment advice. So in general, we invest because we want to see our money grow. On this graph of speculativeness against our current or future profitability, I'm going to plot a few examples to help describe what investing in companies at different stages of maturity means to me. Apple didn't go public via a SPAC, but using Apple as an example of what a successful SPAC might become someday, Apple is a money-making machine. When you buy shares of Apple, you're buying a share of the company's value and the future value the company generates over time. There may be some uncertainty as to how much profit will be generated, but it's within a pretty well understood bound, at least compared to a company like Tesla. At this point in time, I'd say Tesla is at an earlier stage than Apple. Many catalysts are lined up that suggest the company can and will produce massive profits, but Tesla has yet to definitively do so. When you invest in Tesla, you're still buying part of the company and a share of the future profits. But while it is becoming increasingly unlikely for Tesla to ever go bankrupt, it's not known whether the company's innovation and profit will continue to grow exponentially or fizzle out and become, say, okay. Hyliion is yet another step removed. It has a strong business plan and products that are getting tested, but it's not even known if the business plan will actually work out. Having said that, Hyliion was selected after evaluation of over 200 other companies, and the risks of buying into Hyliion are arguably reduced because funding from the SPAC will help see the company through its cash-losing growth phase and into future profitability. So what about pre-merger SPACs like Snapper? What are we really doing here, and why would it be speculative? As mentioned at the start of the video, until a merger is announced, you're effectively buying shares of cash, but there's more to it than just buying into a promise. Snapper units represent $300 million, comprised of 30 million units at $10 per share, in addition to a quarter of a warrant, which probably represents a value of about 25 cents. As such, buying units at the current trading price of about $11 means you're paying about 7% extra dollars per dollar. If no promising companies are found, within a timeline of about 18 months for Snapper, the company will begin dissolving and returning that money, minus whatever amount was used to fund operations over the life of the SPAC. While buying money with your money isn't in itself a speculative investment, getting your money returned is not ideal to you as an investor, as you'll be losing the 7% premium you paid, as well as the opportunity cost of putting that money somewhere else for this period of time. In the end, buying into a management team's promise to find a worthwhile company that has a promising business plan and a promising way to achieve those results is a lot of speculation. So what am I doing with Snapper or future SPACs I happen upon? I have a level of trust in Snapper's management team based on their first merger target being Hyliion, and I certainly align with their mission of seeking innovative solutions to carbon emissions. However, it would not be prudent for me to invest a significant amount of capital into this, as it's entirely possible a good target is not found by no fault of the management team or for their merger target to not turn out to be successful. In addition, 2020 has seen SPACs become increasingly popular, so while the chance of a SPAC not finding a suitable target quickly might be lower, this also results in higher premiums to buy into SPACs, and a higher risk of companies merging through SPACs being of a lower quality and receiving less scrutiny. Overall, I'm at most willing to put some fun money in Snapper as a speculative play before the merger target is announced, and may consider warrants as a relatively cheaper way to increase exposure without committing as much upfront capital. Note, however, that warrants are also likelier to result in a total loss if a merger target is not found. Are you investing in Snapper or other SPACs? Let me know in the comments. If you enjoyed the video or learned something, I'd appreciate if you hit the like and subscribe buttons. Either way, have a great day.